with the Thomas Group and love local real estate, your local Las Vegas and Henderson realtors. Today I'll be going over the 1031 tax exchange. What are the benefits? What exactly is it? And if you're already familiar, stick around to the end because I might know a little something that you're not aware of. Before we get into it, real quick, hit the subscribe button so you don't miss any of our great content, home tours, community tours, things to do in Vegas, and a lot more. So the first thing a lot of you are probably wondering is what exactly is a 1031 tax exchange? The 1031 exchange is part of the IRS tax code that allows investors in real estate to roll over the proceeds from the sale of one investment property into the purchase of another while deferring the capital gains tax on the sale. There's a few stipulations on this. It needs to be like-kind property. Basically what that means is you cannot sell an investment property and buy a painting. You can sell a property and buy a vacant lot. You can sell a single family home and buy a multi-unit building. So it's actually broader than it sounds. It needs to be real estate. The second thing is there's a specific time frame. From the day of sale, there's a 45-day identification period during which you would identify the property or properties that you'll be rolling the sale into. From the same day of sale, you have 180 days to close on the sale of one of those identified properties or more of those identified properties. The third thing is when the sale happens, you do not get the money. The money stays in a third party, usually title or escrow, and they hold the funds until they're ready to be dispersed into the next sale. So by you never actually getting the proceeds, that you are deferring your capital gains tax until the final sale when you are not going to be rolling into another 1031 exchange. Let's look at an example of a $200,000 property that you purchased. When it comes time to sell, you're able to sell it for $350,000. Let's say you put 20% down and you've got some equity in it, and the proceeds from the sale are $200,000. Well, if you don't use that into a 1031 exchange on your next property, you'll actually pay 15 to 20% of that in capital gains depending on your income bracket. For this example, let's say you pay $40,000 in tax, so that leaves you with $160,000 profit. However, if you had used the 1031 exchange, you could have used that entire $200,000 to leverage into new and better properties. You'll get better return prospects, and over time, if you continue to 1031 exchange one after another, that $40,000 you paid really starts to compound over time. And you'll have bigger cash flow, bigger tax shelter with the more and better properties that you invest in. To make the most of a 1031 exchange, you want the replacement property or properties to be of at least equal, if not greater value to the sale price of your original property to get the most advantage out of the sale. If there's any difference in the proceeds from the first sale and you're paying less into the replacement properties, you'll pay capital gains tax on the portion that you did not use from the first sale. Let's go back to our $200,000 investment example. So you sell that one for $350,000 and now you reinvest and you sell that one for $500,000. You exchange again to $750,000 and you keep a handful of more exchanges over your lifetime, and you get older and you end up with a $2 million portfolio or a $2 million apartment building. The major drawback of this, people would say, is at some point you have to pay back all that deferred tax that you've been since $200,000 to $2 million. You technically owe tax on $1.8 million in capital gains. However, I don't know if you know this, if you were to use this as more of an estate planning tool, you could will your properties to your heirs, and when they inherit that $2 million building, they inherit it at the stepped-up basis of $2 million. They're not inheriting $1.8 million of capital gains tax. So effectively, all capital gains is wiped out. This is a really great wealth building tool. It's great to leave a legacy, and if you're continuously investing in better high quality properties which have higher cash flow, they provide a greater tax shelter, they allow greater depreciation write-offs, you can really see where all of this will start snowballing and your wealth will just start multiplying exponentially. Thank you for joining me for this sort of simplified breakdown of a 1031 tax exchange, but I hope I at least gave you the idea and got you as excited about it as I am with the possibilities it can create to make really almost anyone a real estate mogul. You start with a small property and you can keep leveraging the profits in slightly bigger, and slightly bigger, and over time you'll be surprised where your portfolio can go. As you've seen though, it's a detailed process and there are timelines you have to follow, and it is a tax code. So as always, consult your tax professional, your real estate professional, but all of that can be covered in the 1031 exchange since it is a cost of doing business. Until next time, I'm Brittany with the Thomas Group and Love Local Real Estate. Please, if you or anyone you know is interested in buying or selling in Las Vegas, reach out to us at thethomasgrouplv.com. We offer free consultations, and I'll see you in the next video.